Navigating the dynamic landscape of alternative investments can feel like a complex puzzle, especially when it comes to understanding their performance. How do you effectively track assets that do not behave like traditional stocks or bonds? Monitoring alternative investments within a portfolio requires a specialized and adaptive approach, distinct from the methods used for publicly traded securities. It involves focusing on unique metrics, understanding illiquidity, and employing a continuous, multifaceted process tailored to each asset class. The fundamental reason for this distinct monitoring approach lies in the inherent characteristics of alternative assets, such as private equity, hedge funds, real estate, and commodities. Unlike liquid assets with daily market prices, alternatives often lack transparent valuation and can have long investment horizons. This means traditional daily mark-to-market evaluations are often insufficient, and we must instead analyze factors like illiquidity premiums, complex fee structures, and the timing of capital calls versus distributions. Furthermore, risk exposure in alternatives can be highly idiosyncratic, requiring a deeper dive into operational and strategic risks beyond standard market risk metrics. To effectively monitor these investments, begin by establishing a robust valuation process, which may include periodic appraisals or models like the net asset value for private funds. Implement a meticulous cash flow tracking system to record every capital call and distribution, calculating key performance indicators such as the internal rate of return, total value to paid in, distributions to paid in, and residual value to paid in. Conduct regular qualitative reviews of fund managers, assessing strategy drift, organizational changes, and adherence to investment mandates. Finally, consider the impact of these assets on overall portfolio diversification, examining their correlation with traditional assets and their contribution to risk-adjusted returns using appropriate frameworks. A sophisticated technique for managing these assets is look-through analysis, which involves dissecting the underlying portfolio holdings of a fund to understand its true exposures rather than just relying on fund-level reporting. Another crucial practice is commitment pacing, which strategically plans future capital allocations to alternative funds, ensuring efficient deployment of capital while managing liquidity. These methods provide a granular view, allowing investors to anticipate future capital needs and better manage portfolio-wide risk. By adopting these specialized monitoring frameworks, investors can gain a clearer understanding of their alternative asset performance, identify potential risks early, and make more informed decisions about portfolio construction and rebalancing. This proactive and detailed oversight helps to optimize returns and manage the unique challenges posed by these complex investment vehicles, ultimately leading to more robust portfolio outcomes.